The basic character of equity markets is uncertainty. It is this uncertainty which leads to traps. In our recent note, we discussed some of these traps. We are often aware of these traps. It is just that we keep ignoring them in flow with herd mentality. The first one is the correction trap, or let me wait for the correction trap. Investors and advisors, we've often seen, and especially over the last 12 months, they have tended to wait for market corrections. And in the process, they have lost a lot of opportunity. Corrections by nature and by definition are a natural part of the process of stock market behavior and indeed human behavior. Corrections will always happen. There is nothing special about them. In fact, in waiting for a correction, an investor ends up taking not one, but two improbable decisions. The first one is timing, taking the right decision to time the correction in the fall in the markets. And second, timing the bottom, or rather the rise in the markets. We think having a sufficiently long holding period should make a wait for a correction pointless. The second trap is the definition trap, or what we call as the categorization trap. And the most common one here is the market cap trap. Will large caps do better than mid caps, or will mid caps do better than small caps? Again, here we think that it is the underlying business that matters and not the size of the business. Stock market returns are ultimately generated by growth in the underlying business and not by the kind of a size category to which a business belongs to. No two mid-cap companies are similar. No two small-cap companies are similar, except for the fact that they belong to the same size category. At Avendus Olivo PMS, we are market cap agnostic. We find a number of opportunities across market cap ranges, given the fact that the depth and the breadth of the Indian markets have widened substantially over the last few years. The third trap is the quality trap. A good quality business may not necessarily be a good stock to invest in. It all depends on the price you pay for it. A good business may be a bad stock because of overvaluation. At the same time, a bad quality business, which is available at an attractive valuation, maybe it's a good stock, but because it's a bad business, it may not be worthy of investment considerations. We always insist on our good zone of preference, where we like to invest in good businesses at attractive valuations, i.e., which is a good stock. To summarize, corrections will always happen. Definitional and quality traps will always remain. What is important is investing for the long term and realizing that stock market performance ultimately and purely comes from the underlying business and its growth, and of course for the price you pay for it.